interest rates on bonds, they've been inching up, also in the money market space. So we're about to talk to Onyebuchim Obiyemi, who is the head of investment banking division at CardinalStone Partners. You're very welcome, Onyebuchim. Are you the reason why the exchange has been going down? Is it because of the rates going up in bonds that investors are cycling out of equities? I want to ask you actually specifically, that's not what I ask you. Yeah, CardinalStone, non-bank issued bond, I believe it was what? A 5 billion naira tranche, about 7%, yes. Due 2025?
Yes.
Impressive stuff. Tell me about that bond, please. Tell me about that.
Yeah, so the bond was actually issued on December 30, 2020, the 5-year bond at 7%. I think for us, what was very, very pertinent was actually timing. So I recollect that internally, we actually planned to issue this bond as early as December 2019. And so as a first-time issuer, we had to start our rating process. That probably took us till halfway through 2020. We're on the rating process. As a matter of fact, we're done with 3 ratings as early as June 2020, and we actually did our debut commercial paper, 270-day paper, at 7% in August 2020. And then on, we're just looking at timing. So second half of the year was obviously a better time. I think last year, the biggest driver for interest rates in the bond market was actually market liquidity. So in the second half of 2020, there were quite a lot of OMO and Treasury bill maturities. So that meant that there was a lot of funds chasing few instruments. So a number of companies like CardinalStone that came out in the second half of 2020 were beneficiaries of those low interest rate environments where we saw FG go as low as close to 2% levels on comparable FG benchmark bonds. So that was so for us, it was really about timing. And I think for us, how we tried to gauge timing is that we try to look at the patterns of how aggressive government is on borrowing and then our projections on market liquidity. So the biggest thing was timing.
Fantastic. So good stuff. So timing was on your side. You just mentioned government's aggressive borrowing. President Buhari just a couple of days ago wrote a letter to the National Assembly asking for about over 2 trillion naira to plug our deficit. So I want to ask you, on the back of that, what is the current landscape for corporate bonds as we speak?
Okay, so I would say that where we are today, it's not as favorable as where we were half a year last year. So second half of last year, we saw rates go to their multi-year lows, and I mean less than more than 10-year lows on all the different maturities, right? However, different tenors. However, in the first, let's say, half of this year, we're seeing interest rates, of course, inching up. But we're still seeing corporate issuances coming. Why? Because in a rising interest rate environment, because there's a potential for rates to actually go higher, you're still seeing issuers coming into the market. So I would say not as favorable as last year. I would say that's actually a missed opportunity for those who didn't come out to the market last year. But it's now a time to come in. Yes, we're seeing a few corporate issuances coming in, largely because the horizon, and I mean, probably we'll speak about our views on how we think interest rates will go going forward. But yes, it's not as rife, it's not as, the debt is not as high as what we saw last year. But yes, there come a number of issuers who are sort of lined up to come into the market. So we will still continue to see a couple of issuances as we move on. Maybe not as many as we saw late last year, but we'll see some issuers as we progress.
All right, and those issuers are looking for investors. So how would you characterize investor sentiment considering where rates are?
So the great thing right now is that investors know that in a rising interest rate environment, that's the time to take positions. So even here in CardinalStone, right, we're seeing asset management clients breaking maturities to take positions now. Because the reality is that while we know that interest rates are going to be on an increase, you spoke about government borrowing, and probably speak about that later on, that is expected to help to moderate interest rates as we go into the second half of 2021. So now we are seeing investors trying to take positions right now because now is a good time to lock in interest rates. I mean, May last year, if you had tried to invest in a corporate bond, if you have got a corporate bond at 15, 16%, a 5-year instrument, if you did that in November and December 2020, you will be at the 6 and 7% levels.
Fantastic stuff. What about the depth and amount of liquidity in the for the bond markets. There's a lot that's been said about depth of our capital markets. Well, how would you assess things, depth, liquidity for bonds?
Okay, so you know that for bonds, so we look at sovereign bonds, and then there's corporate bonds. Now, for sovereign bonds, banks are largely the participants in that market. So banks are the market makers in that market. So you always see two-way quotes on the sovereigns, right? However, for corporate bonds, then there's size. So government issuances go into tens of billions. So today, for government bonds, we probably have about over 11 trillion bonds, FG sovereign bonds outstanding, right? However, on the corporate bonds market, from FMDQ as of today, you probably have somewhere in the range of about 700 billion is like the outstanding value of bonds. Now, from a size perspective, the lots of FG bonds trade in 100 million lots. That's what FG bonds trade in. Now, you see corporate bonds that come out as low as 2 billion, an offer of 2 billion, 5 billion. In fact, I think the modal size of issuances are somewhere below 10 billion. Okay. So between the 7 to 10 billion. So one, we don't have the size. And two, the largest participants in the corporate bond markets are PFAs. PFAs have long-term annuities, they have long-term obligations, so they typically buy to hold. So the reality is that in the banks, bank flip, they trade sovereign bonds. However, we still don't have banks and such kind of very, very, speculative investors in the corporate bond space. So as long as it's largely the PFAs, we will still have a lot of investors who are just buying to hold, and they will hold to maturity. So there, you will hardly see two-way quotes. However, I'm aware that the NGX and FMDQ are trying to work assiduously to see how they can create more liquidity, even in the corporate bond space.
Thank you so much. Very illustrative there. So steady as she goes, safe game being played in bonds there as far as the PFAs and so on, because the regulator wants them to pretty much hold majority government securities. Are there any other headwinds? Only got less than 2 minutes to go. Any other headwinds, risk factors relating to investing in corporate bonds today?
I think the biggest thing is, one, there's the timing thing. Try to time the bonds, one. And the second thing is now company specific. So you want to invest in a corporate bond, and you're thinking about what is the earnings profile of the company you're about to invest in, and then what are their current leverage levels? All those feed into the kind of credit rating that the company will have. So you would typically want to stay in investment-grade securities.
Fantastic. And what's your outlook on rates and the impact on the market?
Okay, so for me, I look at rates from there are three drivers for me for rates. One is inflation. Inflation has been on the rise. However, it dipped in April, but that's largely because it was the harvest season, dry harvest season. However, we expect that those rates probably inch up a little more between now and August, because it's sort of a lean harvest period. So food inflation largely drives inflation. So we expect that might be on the increase. However, there's also the part of liquidity. We are seeing there are a lot much smaller sized OMO and treasury bill maturities in this year. So that should put a squeeze in the market. However, I think the moderation for rates in the second half of 2021 will come from government being able to borrow the $3 to $6 billion that they're expecting to borrow through issuance of treasury euro bonds. So I expect that in all, I would say we'll see an increase for first half into third Q3.
Onyebuchim Obiyemi, Head of Investment Banking at CardinalStone Partners Ltd. Thank you so much for taking us through the bond market. Appreciate it.